Welcome back. Markets are in the red right now on the completion of Fed Chair Jerome Powell's brief Jackson Hole Symposium speech on the economy. Joining us with their reactions to the central bank's chief's guidance for the markets are TD Securities Managing Director and Global Head of Rate Strategy, Priya Misra, as well as Deutsche Bank Senior U.S. Economist and Strategist, Brett Ryan. Brett, let me start with you because I know the Deutsche Bank team has been looking for a recession at some point in 2023. Now, in the context of the speech, the Fed is going to stay out there and be aggressive to try to bring down inflation. What does that mean for that potential recession call?
Yeah, I mean, I think it increases the probability of our recession call because Chair Powell is really admitting here that, number one, it's going to take a sustained period of below-trend growth and higher unemployment to address this inflation problem. And that's going to be that means a longer period of time. Timing of a recession is always difficult to project, but they're not going to repeat the mistakes of the 70s, which he also talked about in terms of sustaining restrictive rates for a long extended period of time. And from a risk management perspective, the risk of doing too much versus too little, they'd rather commit the error of doing too much. So I think all of those point to a recession, at some point.
Priya, from your perspective, how does that get seen and dealt with differently among consumers, among some of the small businesses that are already feeling those impacts?
Sure.
Right,
so I think.
Sorry, we're going to Priya with that one. Yeah.
Well, I was just going to say that businesses are dealing with not just high inflation, but tighter financial conditions. And I think we didn't hear any sign from Chair Powell that he's concerned about tighter financial conditions or letting the market do the work. They're actually saying they're not close to pausing on the hiking cycle. So I think what we're getting a clear message is that the inflation commitment is unconditional. And he's acknowledging that there could be more pain. So I think what the rates market's dealing with is these rate cuts that have been priced into next year. I don't really disagree that there should be cuts being priced in, but perhaps much later. We're talking about 24 for those rate cuts as opposed to next year, because it sounds like the Fed really wants to get inflation down closer to target, keep policy restrictive for a while, and only then even consider rate cuts. So I think we're in for tighter financial conditions for much longer beyond the challenges of weaker growth and high inflation.
Brett, it's Julie here. Are the rate moves that we've seen thus far working in terms of inflation? Are they starting to work? Kind of what is their effectiveness and expected effectiveness?
Well, I mean, I can give you one example from today's core PCE report. Portfolio management was down 7.8%. It's one of the reasons why core PCE was so weak today. That's due to the stock market. It's due to a lagged response to the stock market falling. Assets under management go down, and that's how that works. So that's one direct channel. But for the more important parts of inflation, which is rents, it's yet to filter through, and it's going to take more time. And exactly to what Priya was saying, the market previously, coming out of the July 27 FOMC meeting, was pricing cuts in the first half of next year, really in Q2 of next year. That's since moved out to September. And as Priya said, I think it's definitely more appropriate for the market to be perhaps pushing those cuts further out. And I think that's what the thrust of Powell's speech was today, is that getting the market's expectations up for restrictive policy further out the curve was sort of the main goal here.
Priya, when you hear the Fed chief talk about potential pain to households and businesses, how do you read that? What is pain?
I read that as the Fed tolerating some rise in the unemployment rate. I mean, we already felt that their estimate of NAIRU, or the non-accelerating rate of unemployment, was closer to 4%. We're well through that. So, some rise in the unemployment rate would not make them pause or start to ease. If Chair Powell's actually saying pain, what's that threshold? Is it 4.5? Is it 5% on the unemployment rate? This tension between the growth and the employment side of the mandate, I think the Fed's telling you that it's still public enemy number one is inflation. And if that means that the unemployment rate's going to get worse and the job market's going to worsen, I think they're going to have to look through it. So I think what we've been used to that Fed put in the equity market or in risk assets in general or the labor market, that put is much further out, I think, than what we've been accustomed to for the last 20 years.
Brett, we'd heard Fed Chair Powell also striking a tone of acknowledgement about kind of the international context here that we see as well, and the global phenomenon that he had said inflation is right now with high inflation. You know, where do we sit right now in terms of kind of that broader context and the combating and the policy decisions that are being made compared to some of those around the world as well?
Well, I'd say that two things. One, emerging markets actually have been fairly ahead of hiking and have hiked aggressively ahead of the Fed. The Fed, I would say, is maybe is certainly ahead of the ECB and others. So I would say the Fed's, on the forefront in terms of the G10 economies. But they have, as Powell said, they have more work to do here. And the other thing that I think was important that Powell mentioned was that the Fed has 2.5% penciled in as its longer-term neutral rate. Powell made an important distinction today that the neutral rate now is likely higher given the higher inflation readings. And so what Powell is saying is that we're nowhere near done, and we need to be restrictive. That restrictive doesn't mean 2.5, above 2.5. It means above that, which if their inflation projection for next year is around 3% for core PCE, they need to have rates well above 3% to get real rates into positive territory. In our view, that's going to need to be closer to a little bit above 4%. And that's what I think he's pointing to here is he's sort of erasing the notion of, well, we've now hiked to neutral. He's saying short-term neutral is significantly higher than what their longer run neutral level is.
Given all of that, Priya, when you look at what the reaction that we're seeing in the rates markets, in the treasury markets, and I'm also, by the way, just seeing that traders are now pricing in at least a 50% chance that we get a 75 basis point increase at the September meeting. Given all of that, yields where they are on the 10-year in particular at a little above 3%, is that high enough? Does that make sense to you?
I think the long end, when we think about the 10-year treasury, there's a lot to do with where the terminal Fed funds is, but it's much longer term. We're also talking about global growth concerns. Does flight to quality, the U.S. Treasury market is still the ultimate safe haven asset. So I think there's a lot more going on with the long end. And, I don't really disagree with around 3% in the near term. In fact, we have it getting closer to 2.5% next year on the long end. I think you might wonder why the market didn't react. We got a pretty hawkish message from Chair Powell today. And I think that was because the setup in 2 today was also fairly hawkish. Rates have been rising for the last few weeks. The market was looking for a bit of a hawkish message. And also, there's a reaction function question, which I think we got some clarity on from the Fed today. But there's also an economic outlook question. What if the economy does weaken faster than the Fed's projecting, or inflation has peaked and comes off sooner? So, even though Chair Powell's saying that they're not looking for rate cuts in the near term, I think the market still prices that into next year because there's an if the economic outlook deteriorates, this is a data-dependent Fed with not a lot of forward guidance. So I think they can change their mind. I think that's why the market hasn't reacted as much. I do think front-end rates are biased higher. But when you look at the 10-year, there's a lot of other things. Europe is slowing, China is slowing. I think that can keep a lid on 10-year treasuries.
There's one final question I have, and I want to ask you both. Brett, I'll ask you first. What do you make of the chair giving such a short speech there in Jackson Hole?
Well, I think it was a great idea, given that last year's long speech, he had to reverse course just 2 months later and pretty much say that everything I said 2 months ago at Jackson Hole wasn't correct, and we have to reverse course. So keeping it short and sweet today was a good idea, I think, in my mind.
Priya, what do you think? Did he learn his lesson from last year?
I would agree. I think it's a good idea, but there's not much forward guidance here. They can't be credible with forward guidance if they're also data dependent. But I would say, look at the agenda of Jackson Hole. It's an academic conference. They're debating big questions like potential output, long-term inflation. These are all issues, I think, that will guide policy. And I think it's good for Chair Powell not to prejudge any of these outcomes because of the high degree of uncertainty. Keep it to the near-term outlook, and then let these longer-term questions define Fed policy going forward.
I think we talked longer than his speech, and I'm really okay with all of it. Deutsche Bank's Brett Ryan and TD Securities' Priya Misra. Good to see you both. Have a great weekend.